will explain what does the word economics mean and how many types of economics are there. Then we will acquaint ourselves with macroeconomics, and then we will explain what are the objective and the major issues in macroeconomics and how many policy options are there to attain these goals or objectives of macroeconomics. And in the last of this lecture, we will explain how many school of thoughts are there to explain the macroeconomic theories. In order to define the term economics, first we see that what came in our mind when we see the word economics. So the word economy came in our mind when we see the word economics. So what does the word economy means? Economy means group of persons whose problems are same. How we can define this same problem? We can see that this same problem is accorded as economic problem. How we can define this economic problem? We can define this economic problem as economic problem is related with unlimited wants and limited means or resources, but these limited means or resources have alternative uses. It means that we can say that people are facing the scarcity of resources, but they have a choice that they could use their limited means or resources alternatively. If we define the term economics, simply we can say that economics is related with human behavior. Human behavior in relation with unlimited wants and limited means that have alternative uses. It means that there is a link between economics and economic problem. What type of link or what type of relationship exists between economics and economic problem? We can say that economics is telling about or dealing with the human behavior in relation with economic problem, because economic problem is related with the scarcity of resources, and economics is telling about the human behavior, that how the people are behaving or what are the behavior of the individuals in relation with the scarcity of resources. In order to define the term economics, we have different perspectives or different views. By using these views and perspective, we can explain or define the term economics as, for example, we can say that economics is the science of wealth. But when we are saying that economics is the science of wealth, we are considering the economics as a theory and admitting that economics has not any applied foundation. But when we are saying that economics is the science of wealth, it means that we are saying that economics has both theory and applied part. That its theories, that economic theories could be applied to increase or enhance the human welfare. We can also define the term economics as it is the science of scarcity. When we are saying that it is the science of scarcity, it means that people have unlimited wants, but the resources to fulfill these wants are limited. So these limited resources brings the problem of scarcity of resources. As economics is dealing with the human behavior in relation with this scarcity of resources, so we can define it as economics is the science of scarcity. We can also explain it as economics is the science of optimization, because all the individuals want to maximize their welfare or want to maximize their satisfaction by utilizing their limited means or resources. And we can also define it as economics is the science of exchange. By using all these perspectives, we can explain economics as we have defined. As I have told you in the previous slide that when we define the term economics as a science of wealth, then we are saying that economics has the only theoretical foundation. But when we explain the term economics as a science of welfare, it means that here we are admitting that economics has also an applied part. So, broadly speaking, economics has two main types, that is applied economics and theoretical economics. Where in applied economics, the theories of economics are applied to enhance or increase the human welfare, where theoretical economics is further divided into normative economics and positive economics. Where in normative economics, we study the economic laws and give arguments and give suggestions. Here we can add something from our own side. But in the positive economics, we studied the economic laws and stayed as it is. Here we could not add anything from our own side. So positive economics is further divided into microeconomics and macroeconomics. Microeconomics is concerned or deal with the study of individual part of the economy, while macroeconomics is studied the economy as a whole. Now we acquaint ourselves with macroeconomics. Now the question arises, what are the goals or the major objectives or the major issues of macroeconomics? So in this slide, we are going to discuss that there are 4 goals or the major issues of macroeconomics. These goals or issues are output and employment determination. And the second is related with price stability. And the third goal of macroeconomics is about economic growth. And the fourth or the last goal is related with the international economy. After defining the 4 different goals or the major issues of macroeconomics, here the question arises, what are the policy options that we can apply to attain these goals or objectives? So here we would explain these policy options. There are 3 different policies that we can apply to attain these macroeconomics goals and objectives. These policies are fiscal policy. Fiscal policy is the exercise of government to control over the public spending and taxes as an instrument to attain the goal of general economic policy. It means that fiscal policy is headed by the government and the tools for the fiscal policy are public spending and taxes. Next policy is the monetary policy. So monetary policy is the exercise of central bank to control over the money supply as an instrument to achieve the goals of general economic policy. So the monetary policy is headed by the central bank and the tool for the monetary policy is money supply. Third or the last policy is the commercial policy, and this policy is related with the international issues like tariff, quota, exchange rate, and etc. Which means that there are 2 different policies or that we can apply to attain the macroeconomic goals and objectives. After explaining the 4 different goals and objectives of macroeconomics and 3 different policy options, now here a question rises, how many school of thoughts are there who contradict in their views regarding the objectives, regarding the macroeconomic theories, regarding their inclination towards the different policy options? Because some school of thoughts prefer fiscal policy, some school of thoughts prefer monetary policy to attain their goals and objectives. This difference in the views or the policy options give rise to the 6 different school of thoughts. These school of thoughts are classical, Keynes, monetarist, neoclassical, new Keynesians and structuralist.
मैं महीनों से एक YouTube क्रिएटर के रूप में वीडियो बना रही हूँ, लेकिन ना 1000 सब्सक्राइबर पूरे हो रहे हैं।
Bismillahirrahmanirrahim. Assalamualaikum viewers. Today's our lecture is about economic activity and measurement of economic activity. So first of all, we will explain what does the word economic activity means, and then we'll explain what are the methods that we can employ to measure the economic activity. Let's start our lecture by explaining the term economic activity. Economic activity means what is being happening in an economy. The system or the framework in which goods and services are produced. It means we can say that whatever we produce in an economy is accorded as economic activity. As far as measurement of economic activity is concerned, here we have a different methods or the choice of 3 different methods or approaches that we can employ to measure the economic activity. These approaches are output approach, income approach, and expenditure approach. Here we have used the symbol capital O for total output of the economy, capital I for the total income of the economy, and capital E for the total expenditure of the economy. The beauty of all these approaches is that whatever approach you are using to measure the economic activity, answer would be the same. It means that total output of the economy has an identity with total income of the economy has an identity with total expenditure of the economy. These three parallel lines represent that this equation has an identity. What does the word identity means? Identity means this equation is true by definition. Now we take an example and prove that how these approaches brings the same answer and how we can prove this identity true. To do so, we have assumed that there are two goods that are producing in an economy. First is orange and second is orange juice. So here some informations are given related to oranging transactions and some informations are given related with juicing transactions, like wages paid to the orange ink employees is 15,000. Taxes paid to the government by the orange ink company is 5,000. Revenue received from the sale of oranges is 35,000. Oranges sold to the public is 10,000. Oranges sold to the juicing company is 25,000. It means that total revenues that the orange ink company receiving by the sale of oranges to the public and juicing transaction is 35,000. That is the sum of this 10,000 and 25,000. Next, the information about the juicing transactions are given, that is wages paid to the juicing employees are 10,000, taxes paid to the government 2,000, oranges purchased from the orange ink company is 25,000, and revenue received from the sale of orange juice is 10,000. So, by incorporating these information, we use or calculate the economic activity by using different methods one by one. So, first of all, we will employ the output approach. Equationally, this approach can be written as y is equals to P1 Q1 plus P2 Q2 plus up to so on Pn Qn. What does this formula or equation means? That by adding the monetary value of all the final goods and services produced in an economy during a specific period of time. As in our example, N is equals to 2. It means that our formula shrinks as. So, our formula for the national income accounting becomes y is equals to P1 Q1 plus P2 Q2. So, here P1 Q1 represents that the revenue that are generated by the production of oranges, and P2 Q2 represents the revenues generated from the production of juice. So, revenue that are generated by the orange ink company is 10,000 plus 25,000, that is 35,000. It means that 10,000 of revenues generating by selling the oranges to the public, and 25,000 are the revenues that are generating by selling the oranges to the juicing company. And P2Q2 represents the revenue of the juicing company, that is equal to the 40,000. But we should subtract this 25,000 that have already been added in the revenue of the oranging transaction. So, in order to avoid the double counting, we should subtract this 25,000. So, by subtracting this 25,000 from 40,000, we get the revenue of the juicing transaction, that is 15,000. By adding this 35,000 and 15,000, we get the national income, that is 50,000. Next, we can use the income approach or income method to measure the economic activity. Equationally, the national income according to income approach can be written as national income is equals to wages plus rent plus rate of interest plus profit. So, by incorporating the information given in our example, we can calculate the economic activity by using this formula. So, here wages that is equal to total wages should be equal to wages paid by the originating company and the wages paid by the juicing company. So, by adding these two wages, we get the total wages. In the same way, we can calculate the total profit of the economy. So, the wages paid by the origin company is 15,000 and the wages paid by the juicing company is 10,000. So, by adding this 15,000 and 10,000, we get the total wages that is 25,000. In the same way, we can generate the total profit by adding the profit of both juice company and orange company. So by calculating these two, we can get the total profit. So first we calculate the profit of the orange company, that is the difference between the revenue of the orange company and the cost of the orange company. So the revenue of the orange company is 35,000 given in the information. So we should subtract the cost, that is 15,000 of the originating company, from the revenue of the originating company. We get the profit of the orange company, that is 20,000. In the same way, we can calculate the profit of the juicing company, that is the difference between the revenue and cost of the juicing company. So revenue of the juicing company given in the example is 40,000. But with the cost of the juicing company are of two types. First, that is purchasing the cost of purchasing the oranges from the orange juice company and the cost of hiring the labor. So we should subtract this cutoff cost from the revenue of the juicing company. So to calculate the profit of the juicing company, that is 5,000. So by adding that 20,000 and 5,000, we can calculate the total profit of the economy, that is 25,000. So by incorporating this 25,000, that is total wages, and this 25, that is the total profit, into the national income accounting equation, we can get the national income according to income approach. So here we have put the information in this equation where we put the 25,000 against total wages and we put 0 against capital R and small r because no information is available in the example about the rent and rate of interest. So we put 0 against both rate of interest and rent. And we have put 25,000 against the total profit. So by adding this 25,000 and 25,000, we get the national income, that is 25,000. Next, we can employ the expenditure approach. Equationally, the approach can be written as national income is equal to C plus I plus G plus X minus M. Here we will add up the consumption by the ultimate user. So public spending on oranges is 10,000 and the public spending on juice is 40,000. So by adding this 10,000 and 40,000, we get the national income is of 50,000. Hence, it is proved here that total output of the economy has an identity with total income of the economy, has an identity with total expenditure of the economy, that is 50,000. So here it is proved that whatever approach you are going to be used to measure the economic activity, answer would be same. Assalamualaikum students. This lecture is about national income and different concepts of national income. So here first of all we will explain the meaning of national income and then we will explain the different concepts of national income. Or in another way we can say that here we are going to derive the disposable personal income from gross national product. Let's start our lecture. As far as the definition of national income is concerned, different economists has defined it differently. He chosen different perspective or different point of view to define the term national income. Here we have taken three different perspective or three different point of view to define the term national income, among which the first method is the production method adopted by Dr. Alfred Marshall. According to production method, Dr. Alfred Marshall has defined the term national income as national income is the monetary value of all the final goods and services produced in an economy during a specific period of time. Equationally, we can write it as y is equals to P1 Q1 plus P2 Q2 plus up to so on Pn Qn, where P represents the price of the commodity, Q represents the quantity of that commodity, and N here represents the number of commodity or the services that are going to produced or performed in an economy during a specific period of time. Meaning that by adding the revenues generated by the production of different commodities or services, we can get the national income from production point of view. The next method or the next point of view is taken by Gardner Ackley is the income point of view to define the term national income. He defined the term national income as it is the sum of income of all individuals in an economy. So by adding the income of all individuals in an economy during a specific period of time, we can get the national income from income point of view. But here a problem arises how we can add the income of all individuals in an economy. So he himself resolved this issue by adding the returns of all the factors of production. We can get the national income from income point of view. Equationally, we can write it as Y is equals to W. W stands for wages, that is the return of labor, plus capital R stands for rent, that is the return of land, plus small r stands for rate of interest, that is the return of capital, plus phi stands for profit, that is the return of an organization. So by adding the returns of all the factors of production, we can calculate the national income from income point of view. So the next method or the third method to define the term national income is the expenditure point of view taken by Irving Fisher. He defined the term national income as it is the monetary value of all the final goods and services consumed in an economy during a specific period of time. Equationally, we can write it as Y is equals to C. C stands for consumption spending plus I. I stands for investment spending plus G stands for garment spending, plus X represents the exports, M represents imports here, and the last term collectively represents the net exports. That could be positive, negative, or zero. So these are the three different point of view taken by different economists to define the term national income. Now we proceed further and explain the different concepts of national income, or we can say that we are going to construct or derive the disposable personal income from gross national product. Concepts of national income. So the first and the largest concept of the national income is the gross national product, and simply we can say that GNP. How we can define the term GNP? We can define it as it is the monetary value of all the final goods and services produced in an economy during a specific period of time. Equationally, we can write it as GNP is equals to C. C stands for consumption spending on goods and services plus IG, where IG represents gross investment, that is the sum of both new investment and replacement of old investment, plus capital G, where capital G represents the government spending, plus X minus M, where X represents exports and M represents imports, and collectively the difference between exports and imports is known as net exports. That could be positive, negative, or zero. Plus NFP. What does the word NFP means and what does the word NFP stands for? NFP stands for net factor payment from abroad. So here a question arises, how we can calculate the net factor payment from abroad? We can calculate the net factor payment from abroad if we exclude the income paid to foreign factor by the domestic economy from the income paid to domestic factor by the rest of the world. And the net factor payment from abroad, it could be positive, negative, or zero. Next concept of the national income is the gross domestic product, and simply we can write it as GDP. How we can define the term GDP? We can define it as it is a monetary value of all the final goods and services produced within the boundary line of the country. Or from the derivation point of view, we can define it as we should exclude the net factor payment from abroad from GNP in order to get GDP. Equationally, we can write it as GDP is equals to GNP minus net factor payment from abroad. In order to get the next equation, we would put the equation of GNP against this GNP, and we would get the equation that is written here. Here we can see that net factor payment from abroad is appeared with both positive and negative sign. So this net factor payment from abroad is cancelled out with each other, and we get the GDP that is equal to consumption spending plus gross investment plus government spending plus net exports.
So I started the business to empower humans through software.
Spending plus net exports. From measurement point of view, we can divide the term GDP into two different types, that is nominal GDP and real GDP. What does the word nominal and real GDP means? Nominal GDP means that GDP measured in current prices. Equationally, we can write it as Y is equals to summation Pn Qn. Here we can see that both price and quantity are appeared with the same subscript, meaning that the quantity and prices of the current time period are taken. It means that we are going to calculate the nominal GDP. But when we are going to calculate the real GDP, the prices of some base period are taken. It means that when we are going to calculate the GDP in terms of base period prices, then it would be accorded as a real GDP. Equationally, we can write it as Y is equals to summation P naught Qn. Here we can see that both price and quantity are appeared with different subscript. Here Qn represents the quantity in the current time period, but P naught here represents the prices of some base period, meaning that we are concerned with to calculate the real GDP. After explaining the terms gross national product and gross domestic product, here we are going to derive the difference between GNP and GDP. So before explaining the difference between GNP and GDP, first we look at these two terms and explore how these two terms are different from one another. As we can see that the word N appear in the middle part of GNP and the word D appear in the middle part of GDP, and these central words made these two terms different from one another. So what does the word N and D means? N means nationals, meaning that nationality of the factors matters very much when we are considering the GNP. We should consider the nationality of the factors while calculating the GNP, as there is an outflow of the income from GNP against the foreign factors serving in the home country, and there is an inflow of the payment in GNP against the domestic factors serving abroad. So we should consider the nationality of the factors while calculating the GNP. But the word D appear in the middle part of GDP, representing that domestic. What does the word domestic mean? Domestic means GDP is considering that residency of the factors matters very much, not the nationality of the factors. because GDP is considering all the factors of production as the residents of the home country, because all the factors of production are working on the domestic resources, so it would be considered as the residents of the same country. So there is a difference between GNP and GDP. How we can explain this difference? We can explain it as remittances sent home by the worker abroad are part of GNP but not a part of GDP. Here we have explained that both GNP and GDP are different from one another. So now we can derive the relationship between GNP and GDP. In order to derive the GNP, we should add the net factor payment from abroad into GDP in order to get the GNP. By using this formula, there could be three different possibilities that if net factor payment from abroad is equals to 0, then both GDP and GNP report the same answer. If the net factor payment from abroad becomes positive, then GNP becomes greater than GDP. But when net factor payment from abroad becomes negative, then here GNP falls short of GDP. Next concept of the national income are net national product and net domestic product. So before deriving the net national product and net domestic product, I should clear the one thing here that all the gross concept of the national income includes depreciation of capital goods in the production process. To make them net, we should deduct or exclude the depreciation cost or depreciation allowances from the gross concept. So what does the word depreciation cost means? Depreciation cost means the portion of capital stock that wear out each year. Now we are going to derive the net national product and net domestic product. In order to derive the net national product or NNP, we should exclude the depreciation allowances from GNP in order to get the NNP. In the same way, we can derive the net domestic product by excluding the depreciation allowances from GDP. We would get net domestic product. Next concept of the national income is the national income. How we can define the term national income? We can see that income received by the household in the form of wages, rent, interest and profit, irrespective of whether they are earned domestically or abroad. Here a question arises, how we can derive the national income? So in order to derive the national income, we should subtract the indirect taxes and add the subsidies into net national product. So what does the word indirect taxes and subsidy means? Indirect taxes means it is a type of tax where the initial and final tax burden is on the different persons, meaning that it is the type of tax where the tax burden could be shifted to another person. How we can define the term subsidy? We can see that subsidy is the type of government expenses that are extended to farmers to reduce the cost of production or to reduce the prices for consumer. In another way, we can say that subsidy is the type of negative tax because they impose expense on government budget instead of generating revenues. Equationally, we can write it as, in order to derive the national income, we should subtract the indirect taxes and add the subsidies into net national product in order to get the net national income. Next concept of the national income is the personal income. So here a question arises, how we can derive the personal income? So in order to derive the personal income, we should subtract the undistributed corporate profit, corporate and social security taxes and add transfer payment into national income. Equationally, we can write it as personal income is equals to national income minus undistributed corporate profit minus corporate tax minus social security distribution plus transfer payments. Now we will explain all these terms one by one. So what does the word undistributed corporate profit means? Undistributed corporate profit means it is the type of profit that is not distributed among the shareholders in the joint stock companies. So what does the word corporate tax means? It is the type of tax that is imposed on income or profit of the corporation. How we can define the term transfer payments? We can define it as it is the type of income received by an individual for which no economic activity is being performed. Next concept of the national income is the disposable personal income. First, going to explain the derivation of disposable personal income, we would explain here that the personal income that we have derived in the previous slide is not available for spending because it includes the direct taxes or the personal taxes that should be excluded to make the income available for spending. So here a question arises how we can derive the disposable personal income from personal income. So in order to derive the disposable personal income, we should deduct or exclude the direct taxes from the personal income. Equationally, we can write it as disposable personal income is equal to personal income minus direct taxes. Here a question arises how we can define the term direct taxes. So the direct taxes are the type of taxes where the initial and final tax burden is on the same person, meaning that it is the type of tax where the tax burden could not shift to another person. So disposable personal income is the type of income that is now available for spending, and a household or an individual can divide it into consumption and savings. Here we are going to explain the GDP gap. As GDP gap is the difference between potential GDP and actual GDP. So first of all, we will explain the meaning of potential and actual GDP. So what does the word potential GDP means? It means monetary value of all the final goods and services that an economy can produce by utilizing the all existing resources of an economy. We can define the term actual GDP. We can see that it is the monetary value of all the final goods and services that an economy actually produced by utilizing the existing resources of an economy. After defining the term potential and actual GDP, we would explain how the GDP gap could become positive, negative, or zero. GDP gap could be zero when potential and actual GDP becomes equal to each other. GDP gap is positive when potential GDP is greater than actual GDP. And when GDP gap becomes negative, GDP gap becomes negative when potential GDP falls short of actual GDP. In the last of this lecture, we are going to explain the meaning of per capita income and the derivation of per capita income. So what does the word per capita means? Per capita income means it is the per head income or per person income. How we can derive the per capita income or the per head income? In order to derive the per capita income, we should divide the national income of the economy by the total population of an economy. By doing so, we can calculate the per head income or the per person income of an economy. Bismillahirrahmanirrahim. Assalamu alaikum viewers. This lecture is about the derivation of gross national product from disposable personal income. As we have derived the disposable personal income from gross national product in the last lecture, in the same way, if the information are given in such a way and it is asked from us to derive the gross national product from disposable personal income, then here a question arises, what would be the process or what would be the scheme by which we can recover the gross national product from the disposable personal income. So here we are going to share the process by which we can derive the gross national product from disposable personal income. Let's start our lecture and explaining the process by which we can recover the gross national product from disposable personal income. Here is the process of the derivation of gross national product from disposable personal income. As we know that disposable personal income is equals to personal income minus direct taxes, where direct taxes represents the type of tax where the tax burden could not shift on another person. By seeing this equation, if we want to solve this equation for personal income, we can derive the personal income as personal income is equals to disposable personal income plus direct taxes. And now we can derive the national income from personal income. We can derive the national income from personal income as national income is equals to personal income plus undistributed corporate profit plus corporate taxes plus social security distribution and minus transfer payments. By doing so, we can recover the national income from personal income, as we know that the personal income is equal to the national income minus distribution of corporate profit minus corporate tax minus social security distribution plus transfer payment. So we have solved just this equation for national income. In that way, we can recover the national income from personal income. Next, from the personal income, we can derive the net national product. So in order to derive the net national product, we should add the indirect taxes and subtract the subsidies into from the national income. Then we can get the net national product. And when we have the net national product, so it is easy here to derive the gross national product from net national product, as net national product is equals to GNP minus depreciation allowances. So solving this equation for GNP, we can obtain it as GNP is equals to net national product plus depreciation allowances. By following this issue, we can recover the gross national product from disposable personal income. Bismillahirrahmanirrahim. Assalamu alaikum viewers. This lecture is about the circular flow of national income, meaning that we are going to explain that how the national income changes hands. We can see that whatsoever is being produced by the producer is sold out to the consumers. So the sum of all those goods and services that are produced in an economy is accorded as national income. While on the other hand, consumers spend all of their earnings on the goods produced by the producers. So the sum of all those expenditure is also represents the national income. Further, the household are also providing the services of the factors of production to the producers. Against those services, they receive the remuneration. The sum of all those earnings is also represents the national income. So here we are going to explain that how these three different flows ultimately merge. Let's start our lecture. In the previous lecture, we presented that there are three different methods of measuring national income. That is production method, income method, and expenditure method. If we analyze all these three different methods or approaches of measurement of national income, we come to know that all these approaches or the method of measuring national income brings the same result or same answer, meaning that total output of the economy has an identity with total income of the economy, has an identity with total expenditure of the economy. It could be better explained with the help of circular flow of national income. Before constructing the circular flow of national income, it is told that we are considering the economy